Good afternoon or good morning, everyone. Anthony Alaka with Torrey Hills Capital, and welcome to the Cerrado Gold webcast for September 30th, 2025. Hope everyone's doing well, and thank you for taking the time to join our virtual lunch or virtual breakfast, I guess, in this case. We are very excited to bring you Cerrado Gold. They are a Toronto-based precious metals mining and exploration company with three assets. The company's Minera Don Nicolas project, located in Argentina, is producing gold and silver. It's a producing, gold and silver mine with significant optimization, expansion, and exploration potential. The company also holds an 80% interest in the highly prospective Lagoa Salgada VMS project in Portugal and 100% interest in the Mont Sorcier iron project located near Quebec. Trades on the OTC market under the ticker CRDOF and on the TSX Venture under the ticker CERT. And it's currently trading with a market cap of only 125 million US. We feel the stock should benefit from the long-term positive outlook for resources and the many positive investment catalysts expected for the next 12 months, one of which Mike just mentioned before we got started. With us today to discuss Cerrado Gold's operations and growth strategy going forward is the company's VP of Investor Relations, Mike McAllister. Mike, as usual, it's great to have you on today, and thanks for bringing us up to speed on all the great things happening at Cerrado. But before we get started, I just want to let everyone know, I think everybody's familiar with the format here. If you have a question, just type it into the Q&A or chat box, and we will make sure that it gets answered. So with that said, I'm going to turn it over to Mike McAllister. Mike, the floor is yours.
Great. Thank you so much, Anthony. And thank you, everyone, for taking the time to hear the update today or hear the story if it's your first time hearing this. Just going to move ahead. So I will be making forward-looking statements. I seek safe harbor. So moving into the story, we are excited. We have a great mine here in Argentina. We have production here at 55,000 ounces over the next 3 years. That's based on a recent PEA. And we have the potential to expand this mine life. One of the things we're doing right now is we announced earlier this year a 20,000 meter ongoing program targeting some additional resources for the CIL plant. So we were looking mostly at surface exploration adjacent and around the existing areas that we had been mining. We are having some initial success. One of the things that we were finding, though, is the assays were taking too long to get back. And one drill just isn't moving fast enough, and we think we have potential here. So we actually just put out a press release this morning, about an hour ago, that said, we're adding additionally 3 more drills, 2 more diamond drills, which will add to the existing one. So we'll have 3 diamond drills in total, and an RC rig, which will be used as well. So with that, we're going to be able to, and it's going to take some time. The one drill will come in soon. The other one will come in next month. So we're guiding for to increase next year to a 50,000 meter drill program on the property. And we are going to be certifying our lab on site, which means that we can complete all the assay work and everything right on site and not have to wait for the results here. So very exciting stuff there, because that's going to help us to ramp up the exploration significantly. And we're hoping that by the end of this year, even with the 20,000 meter program, we'll be able to demonstrate a proof of concept for additional resource addition and mine life expansion at this property. And so we're very excited about the news today. Additionally, one of the things we like about this property is the free cash flow. So we did a PEA study at $2,100 gold. We saw 50 million a year of cash flow, 25 million a year of free cash flow. Obviously, at today's gold prices, much higher than that, probably looking at 50+ million a year of free cash flow. So very, very sensitive to the gold price going up. And the thing we like about this also is, as we ramp up production here in the latter part of the year, as we go underground and get the higher grade material, the increase in ounces will benefit us, because we have fixed costs. So the cost per unit will continue to come down as we're producing more ounces in the fourth quarter of this year. And so the other thing, as I mentioned, the underground development that was started at the beginning of Q3. We are now reached and are starting to drill and mine from the underground areas. And so, as I mentioned as well, the higher grade material comes as we move into these areas into the fourth quarter. So excited about that. So that's our existing mine in Argentina. Beyond that, and we also have a significant, substantially developed underground or undervalued assets. In one, the Lagoa Salgada mine, which is in Portugal. It's a low-cost VMS, volcanic massive sulfide deposit. We like this mine because it has district-scale discovery and exploration potential. So while While we're working on this, we have a 14-year mine life with only 40,000 meters of drilling. We're only touching on what could be the potential of this mine. And so we will have a construction decision on that property in the first quarter of 2026. We'll be completing an updated feasibility study on it, which will be coming out probably mid to end of Q4. And the thing we like about that study is you'll not only see increased reserves and resources, you're also going to see lower construction costs, improved economics based on the work that we've done there. And I'll talk more about that as I get into the presentation. And then again, longer term optionality beyond this is the Mont Sorcier project, which is located in Quebec, Canada. We're completing a feasibility study on that project right now. That'll be done in the first quarter next year. What this is it's a high purity iron ore project of about 5 million tons per annum, concentrating to 67% iron ore. And so a lot of people don't understand the difference here. And the difference is iron ore is based typically at about a 62% concentrate. 65 is considered a premium. 67, it makes it 67 or greater makes it it's called direct reduction iron or a high purity iron. And the thing that differentiates this is high purity iron can go directly into an electric arc furnace. And it's the other thing that you have is the regular steel producers here in North America, even if they're not using electric arc furnaces, they still like this material because it's cleaner, it's easier on their smelters, it reduces their costs. So it's a very high demand product, typically growing at about 10% per annum versus regular iron ore, which grows at about 1% per annum. So definitely something we're excited about. As I mentioned, we have a bankable feasibility study coming in the first quarter of next year, but we also did a PEA in 2022 that had a post-tax NPV of 1.6 billion. So very valuable project. And I'll talk again a little bit more in detail later in the presentation. The company is well funded. We have 14.5 million in cash as of June 30th, and that includes the Hochschild payment for the Minera Don Nicolas mine. We still have cash that we're generating from the project from Minera Don Nicolas. So as I mentioned, at the feasibility study prices is about 25 million. However, with today's gold price, that's probably 50 million plus free cash flow coming from that. That's adding to the balance sheet. And then we also have some additional proceeds coming still. 5 million is the last payment Hochschild has to make for the purchase of the Minera Don Nicolas, the Monte do Carmo asset in Brazil. And then we also have an area that we're optioning to Anglo Gold in Argentina. It's at the very south of our property. It's an area that would not have been economic to get up to our mill. So we were working with Anglo. They're doing some drilling on that. They've already paid us $3 million. And then if they decide to take the option, which is looking like they will, that would be an additional 10 million. So the balance sheet is in a very healthy position. We're well funded to develop these projects, and we want to make sure that we continue to minimize dilution for shareholders while we grow this project and maximize value for them. Taking a look at the investment highlights here, you can see at the project in Argentina, when we acquired this property, they were producing at about 16,000 ounces. We acquired this property for about $45 billion. The previous owners were white good manufacturers that were trying to import US dollars into Argentina. They spent about 200 million developing the mine, the plant, and could never get it to work properly. We purchased it immediately. We were able to get it up to 42,000 ounces the next year. And we're currently running at about 55 to 60,000 ounces at this property. With the exploration we're doing and with the underground mine exploration we're doing, I imagine you're going to see that number continue to grow in the coming years, and as well as the mine life continue to grow on the property. In terms of precious metal focus, we're still very much precious metals focused, even with the addition of the property in Portugal. That adds another 23% precious metals already. If you're looking at the company as a whole, 39% from MDN. And if you're using, so it's 62% precious metal component for the company. If you use spot metal prices and do it from a revenue basis, then it jumps up to 81%. So we still very much are focused on precious metals, and even in our work and M&A opportunities, we're looking at other opportunities, and we continue to review other opportunities to increase the precious metals exposure. However, we do still have some critical minerals exposure at Lagoa Salgada, including copper, zinc, and tin, which are very much in demand in Europe. So it will be good to feed into those requirements. Looking at the company overall on a value proposition, right now the market cap Canadian is about 170 million, around 100 million US. The cash in the bank is about 14.5 million. And then, as I mentioned, we still have some outstanding payments coming. Argentina, we see free cash flow, as I mentioned, at 25 million, but that was at $2,100 gold. At today's gold prices, that's closer to 50 million plus. We do have an NPV of 146 million in Portugal. And longer term, we have the opportunity in Quebec, which is a 1.6 billion NPV on that property. So we feel that you're getting a significant amount of value in this company for what really is probably only the value of the project in Argentina. And so, again, while the price has had a run lately, we believe it still has a way to go to see its realized value where it should be. Taking a look at the project from an investment perspective, again, if we look at this from a gold equivalent production basis, currently we're at about 55,000 ounces. When we bring in the project in Portugal, we'll bring that up closer to about 100,000 ounces of gold equivalent production. When the project in Quebec came on, that would be over 300,000 ounces of gold equivalent production. If you're looking at it from a NAV perspective, and again, all of these values are the technical reports that were published, and so we're using the values from there. Obviously, gold prices have significantly increased, as other metals have as well, and so these would be much higher today. For example, you have MDN with a NAV of 111 million. That would be much higher today. But once you add in Portugal, that brings it up to 258 million, and we're up to almost 2 billion of valuation from an NAV perspective once we bring in Mont Sorcier in Quebec. If you like to prefer to look at it from a cash flow perspective, looking at EBITDA, as I mentioned, 44 million from MDN. Obviously, that's 100 plus with today's gold price. 112 when you bring in Lagoa Salgada. But once we bring in the Mont Sorcier project in Quebec in 2030, we'd be looking at almost $500,000 of cash flow for these, or sorry, $500 million of cash flow for these projects. And in a 5-year period, that's for a mining company, that's pretty substantial to see the amount of growth that we're going to see in the next 5 years, or less than 5 years now, at these properties. So we're quite excited about this. We call this a year of transition for the company. We're doing a lot of work here, and there's a lot happening. We do have a producing asset, as you mentioned, or as I've mentioned. We have the heap leach production that's already happening there. We're doing this surface exploration program. It's 20,000 meters this year. We've just announced it's going to be 50,000 meters next year. We're expecting big things from that. And then we also have next year, we're going to be doing some underground exploration. And so the previous operators didn't do any underground exploration. They only liked surface exploration. From the bottom of the open pit, we're targeting in 26. We're mining that now, the areas that are in reserves. But below that, everything is still open to depth. And I'll show you that in a picture coming up. So that's targeted to happen in 26. And that's expected to add some significant further mineral resources and mine life to the mine. We see free cash flow, as I mentioned, probably with today's mine prices in excess of 50 million coming from this mine. And then we also have Lagoa Salgada, the project in Portugal. We'll be doing a feasibility study that'll come out by the end of the year. We also have our permit by the end of the year from the environmental perspective. Recape, which is the detailed engineering and the construction permit, we expect that by the end of the second quarter. We'll be in construction in Q3 next year, production starting in the first quarter of 28. From the technical report, we'd see free cash flow about $75 million a year. That's likely going to be higher when we put out the updated feasibility study on this project. If I had to guess, I think it would be closer to 100 million. And then Mont Sorcier, the bankable feasibility study, we're going to complete in Q1 of next year. We'll then move on to the environmental. We'll announce the financing in the first quarter of 28. Construction would start in the second quarter of 28, and we'd be in production by Q1 2030. The longest part here in Canada with Mont Sorcier is permitting is still a long process. The new government had announced that they're trying to shorten that. We are seeing some areas that are starting to see some advancements. So hopefully we can see the permitting shortened in this time frame and potentially see this project come in a little bit sooner into production. Taking a closer dive or a deeper look at the projects, this is the Minera Don Nicolas project. It's what we like about this is we have the largest land package in the Deseado Massif, which is an area in Santa Cruz, which is a province in the very south, close to Patagonia, in Argentina. And so outside of the government, we have the largest land package of 330,000 hectares, which would be similar to the size of Rhode Island, if you want to give it an equivalent. And so what we like about this is we're in a very prospective area. The Deseado Massif is a very similar geology to Nevada. However, it's only been mined for the last 20 years versus Nevada, which has been mined for a few hundred years. And so this is a relatively young mining camp, and there's a lot of opportunity coming in here. We have some excellent neighbors. We have Pan American, which is to the southeast of us with their Cerro Moro project. We also have Cerro Vanguardia, which is Anglo Gold to the south of us. Cerro Negro, which is Newmont to the west of us, as well as San Jose, which is Hochschild and McEwen Mining. So very prospective area that we're in. There's been a significant amount of gold mined from here, probably 6 million plus ounces. And so we're very excited to be here. You can see on the chart on the left, the green area represents all of our concessions that we have. The Michelle project that I mentioned that we're doing an option agreement with Anglo is way down here to the southwest. And so this would have been not economic to bring up to our mill. And so that's one of the reasons we agreed to do an option on that. But as you can see, it's a very desert type area. There's not much around. There's very muted vegetation based on how cold it is there. But so I think our nearest neighbor is about an hour and a half to 2 hours away from us. And so you have the state highway that runs past the property, the gas line, which we tap into for power generation. But other than that, there's not a lot around us.
Mike, one of the questions that came in is, I guess on a percentage basis, how much have you explored at Minera Don Nicolas, and how much is left to explore? And do you have a time frame of when you're going to really expand the exploration there?
So I would say on the whole property, we probably only touched about 15, maybe 20% of it. There's significant, I'll show you in a chart coming up. We have significant amount of targets on the property. So we are ramping up. As I said, we're going from 20,000 meters to 50,000 meters next year. That will likely, between this year and next year's drilling program, at least bring us to a 10 plus year mine life, if not larger. At the same time, once we hit that 10-year mine life, we probably won't do a lot more beyond that, just because you only get paid for about a 10-year mine life in terms of valuation. So we'll continue to explore. The drills will always be turning. We might scale it back a bit after we hit that 10-year mine life. However, just to say of the property, there's significant targets here that we can continue to expand on over the next couple of years. If we wanted to keep the mine life there and continue to ramp up and keep exploring at a higher level, we could look at then potentially expanding the mill and expanding throughput there. The current mill would allow us to get up to about 100,000 ounces of production with the heap leach, maybe a little bit more than that. But once we hit that area, we'd probably have to look at a mill expansion to expand production beyond that at that mine.
Great, thank you.
So this is what we're trying to do in Argentina is nothing new. This is a road that is well trodden and has been done before. Cerro Vanguardia started with about 4.5 million ounces in an open pit mining. They then brought on some heap leach, very similar to us, and then they went underground and they ramped up their mineral resources there to about 6 million ounces. And so then you also have Newmont, very similar. They started with a much smaller resource, about 600,000 ounces. They started in the underground. They opened it up with some open pit resources on this. And, they have gotten themselves up to about 6 million ounces as well. And that includes some acquisition of some smaller targets in the area. And then you have Cerro Moro, which is Yamana, now Pan American, and they started with about 600,000 ounces. They went up to about 1.7 million ounces. Pan American's been making several other acquisitions, so this mine is not getting as much attention as it used to. However, it does have a significant resource on it, and it does have a lot of other untapped resources on the property to be able to grow. And so what we're doing here is nothing different than our neighbors have done. It's a very prospective land package. We started at about 1 million ounces, and we're continuing to drill. One of the things that held us back is when we first purchased this property in 2020, it was COVID. In Argentina, they took COVID very seriously. We could have the operators at the mine, but we weren't allowed to have any exploration or any personnel at the mines that didn't have a specific role in terms of extraction of the resources. So exploration had to take a back seat. And now we're in a position with cash flow to be able to ramp this up and to develop this. So I think our chart will start to mimic some of these other ones in the coming years as we continue to explore the property. Again, this is our production. As I mentioned before, we bought the mine. We were at about 16,000 ounces. We ramped it up immediately. We're up to about 55 to 60,000 ounces. Our costs are estimated to be between $1,500 and $1,700 per ounce. The earlier part of the year was on the higher end of that. As we ramp up production, especially with the higher grade material that will come into the mill in the fourth quarter, we'll see an increase in production, which will see the cost per unit drop. As I mentioned, we have a lot of fixed costs at the mine, and so the more ounces we produce, the cheaper it is per ounce. And so the one thing we do like to mention too is, given that we're a much smaller operation than our neighbors, which have operations of scale, we're still very much competitively priced on an all-in sustaining cost basis per ounce. And given today's gold price, we're seeing very healthy margins. This was the study that we did on the property. We did looking at 55,000 ounces. It had a 5-year mine life. It was an NPV for 111 million. We used $2,100 gold price, which gave us cash flow of 15 million, free cash flow of 25 million. The thing we like, as I mentioned about this, is today's gold price. Obviously, EBITDA is north of 100 million, and free cash flow is in excess of $50 million on the property. And so we're excited about that. With all the drilling that we're doing on the property, now we'll likely see an updated 43-101 next year, which will lock in increased economics on the property, including the higher gold prices that we're experiencing now. And so with that, we'll continue to reduce the debt, which we have already done significantly this year, and we will continue to ramp up on the heap leach development. But the thing we're excited about is with the underground, that's going to ramp up the mill, as well as any gold that we find through these exploration programs. Any of the higher grade material we find will go to the mill. Anything that's lower grade, we can put to the heap leach, which is a very low cost way of extracting the gold. And we just, the thing that we like about that too is we can put those heap leach projects anywhere on the property. What we do is we crush, we have the pad, and then we just bring the pregnant solution to the mill. And so it's a very efficient way of mining some lower grade materials around the property, very low cost. And so there's a lot of opportunity to expand not only the heap leach, but with the exploration we're doing, we expect to find some higher grade material, which is going to fill the mill and ramp up production tonnage, and as well as increase our mine life. This is the open pit that I previously was talking about, the Paloma Underground. So this white area here was the original open pit. This was designed at about $1,800 gold. If this was designed today, it would be much deeper and much longer. However, it is what it is. So we've actually gone in at the bottom of the open pit and put in 3 portals to access all areas in the underground here. We'll be mining just below the open pit. There's an area that's already in the mineral resources here that we're going to be mining now and into next year. However, as you can see, the ore body continues at depth and along strike in every direction. And so what we're doing now is we're going to be mining, and then early next year, we'll set up drill platforms underground to be able to finish drilling off this target. And so drilling from underground is much cheaper. You're right at the resources. We'll be drilling right into resources as soon as we start to drill. So we're very excited about this. And this will come in from an exploration perspective early next year, but we are starting to mine out the area below the open pit that's in resources now. And so we should see good material and then higher grade material coming in as we reach the higher grade targets, probably in the latter half of the fourth quarter. We're also drilling on the surface. So this is the 20,000 meter program we announced this year. We had 5 targets that we were chasing. We started up in the north at Reina and Princess veins, and now we're down in the Sulfuro East vein to the south. And just to show you, that's this area here. Some past drilling that had been done there had shown almost a meter at almost 16-gram material. We also had 3 meters at 6-gram material, including a meter at almost 30 grams of gold per ton. So some very good targets, and this is what we've been following up on. And so we're still at the Sulfuro East vein. We are drilling. We had just one drill, and it was going a bit slow, which is one of the reasons the company has decided to ramp up and bring on the extra drills and improve the exploration program.
So, Mike, one of the questions that came in is, can you define the quote positive initial findings mentioned in the press release that made you add rigs, and this was it, correct?
Yeah, well, these initial findings were historic, but we've done some drilling beyond that, which has had some good success. We're getting some good grades as well. I can't say those yet because they're not public information. We have to do a 43-101 to put those out, and they're doing a proof of concept. But I can say that there's similar grades to this, and so that's what we're finding is that we've drilled down here. We've found similar grades, similar widths. And so that's what's exciting us and helping us to expand the program.
Great, thanks.
So the Minera Don Nicolas exploration property, somebody asked how much of the property we've explored. So you can see here, there's a few names that are mentioned, but all those blue concessions are all our property. Some of the other areas that we're going to explore. So Paloma Norte is just north of the pit. That's the Princess and the Reina vein. So that's one area we've started exploring. Paula Andrea was an area, so you can see over here on the chart, Paula Andrea is just below the open pit. We actually had mined some of these veins at the surface, and we had some really good material here. We also had, we put out a drill hole last year from here where we had 12 meters at about 122 grams per ton. So excellent hit. And so what we have to do now is we're going to be going down to depth and drilling at depth here. And so we're very excited here to get some other excellent grades. So this is another target beyond where we've been drilling so far. And then Chispis, which is this area right here, is another target that we're going to be chasing next year. And so what we like about this one is it's on strike to Cerro Moro's Nazi discovery, which was a very high-grade discovery they had. This is about 3 kilometers away. However, the gold trend continues right through our zone here. So we're going to be drilling on this. We do have, there's a smattering of other targets on the property. So while this is, we have a lot of exploration to do in the next couple of years, there's still significant targets on the property beyond this, which haven't even been plotted yet. So again, this is going to be a mine that's going to be around for a while. The next project we have is the Lagoa Salgada project, which is located in Portugal. We own 80% of this project, and we had a feasibility study completed on it, which showed an NPV of 147 million and a 39% IRR. We'll be updating the feasibility study on this project. One of the reasons this we're updating it is because when we were doing our ownership earn-in, we went from 55 to 80%, but we had to complete a feasibility study by a timeline. And so that put a bit of a rush on it. So we did complete the feasibility study. It wasn't perfect. And so that's why we're upgrading the feasibility study now. It will have improved metallurgy, and I'll talk on a slide coming up about what's changing in it. But we do expect to see superior economics, including hopefully seeing the NPV closer to 200 million. And we should also see the CapEx to build the project drop as well. So overall, it's going to be very positive. But this project, even in its current form, added 42% gold and silver, 24% zinc, 14% copper, 5% tin. The other thing we like about this project is it's one of the lowest cost projects out there. So because zinc is the highest metal that comes out of the project, we have to report on a zinc equivalent basis. And so for the first 5 years, it's 59 cents a pound zinc equivalent. Life of mine, it's 79 cents. And I'm just going to drop down a page here to show you. This is the zinc chart for every zinc equivalent project in the world. At 79 cents, we're in the first quartile, and that's the life of mine cost. For the first 5 years, 59 cents is at the very bottom of the cost curve. So it's a very low cost mine. And as you can see, the metals being mined here, zinc is the highest at 24%, but we still get 42% precious metals coming from this, as well as some copper and some tin. So what's happening at this project? We are optimizing the feasibility study by the end of the year. We do expect to have our environmental approval as well by the end of the year, and we'll be in a construction decision in the first quarter of 26. going to production in 28. Again, we expect limited or no equity dilution to bring this project to production. We're fully funded to the construction decision as well. We have backing from the UK Export Credit Agency. Banco Santander is willing to lend for 70% of the non-recourse project financing. We also have Sprott royalties, which would like to come in, and we have some potential off-takers. So between all those factors, as well as equity that the company can put in from its cash flow, we don't expect to see any equity dilution to shareholders to bring this project online. And also just to show where this project's located, this is the Iberian Pyrite Belt here in the orange. Our project is up in the north west corner of it. We have some very good neighbors. We have Aljustrel, which is a private mine, very similar mineralogy and production as us. You also have Neves Corvos, which used to be Lundin, just got sold to Boliden. Both of these projects sold recently for in excess of $6 billion. So very valuable projects. Some of these projects in the other end of the belt have been around since the Roman times, including the Rio Tinto mine. So these projects tend to have very large expansion capacity and very long mine lives. And we believe that will be the same at Lagoa Salgada. I already talked about the costs here, so I'll just move on. In terms of our timeline, we do expect to see the updated feasibility study by the end of the year, our environmental approval in the first quarter. The RECAPE, which is the detailed engineering, by law has to be completed in 120 days, so that would be at the end of the second quarter. Our project financing will get announced around the end of the first quarter, all the components of it, and we'd be in a position to break ground at the beginning of Q3 with first production in the first quarter of 28. So the project is moving along on a nice timely basis, and we're excited about that. As I mentioned earlier, we're redoing the feasibility study, and why are we excited about this? One of the biggest factors was the metallurgy. We were able to improve the concentrates so that we see not only increased recoveries of metals in the flotation, we also see increased grades, and we're reducing the penalty elements for things like arsenic and other antimonium, which they don't want. And so we're able to reduce those as well as improve the grades. So we'll get a higher NSR per ton. In terms of the resources, because we're able to have a higher NSR per ton, we're able to include other areas. And so we're going to probably see, if I had to guess, somewhere between a 25 and 40% increase in the resources at the property. And then we also have initial capital, which will be lower. We brought in a very strong guy named Guy Lazer, who also worked at Neves Corvos and Aljustrel. And he was able to see our capex, which was around 164 million, bring that down closer to about 150 million on this project. So we're going to see an initial cost that's lower than the previous feasibility study. We also are looking at some trade-offs. We're moving to dry stack and pumping some of the wet tails back into mined out areas, which will reduce our footprint on the surface. And dry stacks is a lot cheaper and a lot more environmentally friendly. And then finally, the last part of it was the mine optimization. We had originally done 1.2 million tons per annum, where we believe now the proper sizing for best economics is going to be somewhere around that 1.5 million tons per annum. So the final numbers will all be out in the feasibility study, but as you can see, there were multiple areas that were looked at here and improving this feasibility study to get the best economics for this mine.
Yeah, and so one of the questions that came in was CapEx at Lagoa Salgada. So you think that is trending at about 150?
Yes.
Okay, great. Thank
Yep.
you.
No worries. So just to say, when you're looking at the Iberian Pyrite Belt, these VMS deposits typically start in pockets. So if you look at Sandfire, the Aguas Nidas deposit, these were this blue area here was the initial three pockets that they had. Through continued discovery, they've continued to add multiple pockets on, and this is a very large scale deposit. It's been around for 20 years. I think they're producing, I think their project is about 1.5 million tons per annum, but you know, their production is significant here. Boliden, which bought Neves Corvo were the original deposits. They also had Zambul, and they've added Lombardo. And so one of the ways that you are able to find the deposits on the Iberian Pyrite Belt is a lot of the time through gravity and IP anomaly work. And so they used something called Titan 24, which is like a deep penetrating survey. And that's how they found Lombardo here at Boliden. We already know we have one more area here. It's a copper-rich area to the south, to deeper in the north area. We're doing some more work on that. We also had the government ran, it's a deep penetrating IP survey. We should start to see some results from that by the end of the month, but it'll definitely give us more targets to chase after here. But we know that everything is open to depth and along strike. And so the one thing I like to point out to people is we have a 1.7 kilometer area where all the mineral resources lie in right now. So this was the 40,000 meters of drilling, but we have an 8 kilometer strike. And so we're only working on, about a quarter of the entire strike. So this is where we say it would not be unrealistic to expect this to grow at depth and to find multiple of these pockets or clusters on the deposit. And so even when you look at it, we have a 14-year mine life for 40,000 meters of drilling. And you think of look at that in comparison, even to Argentina. We're doing 20,000 this year, 50,000 next year. And although we're going to see growth there, the prospectivity or the amount of resources found per meter drilled is so much higher here, and it's so much more robust. And so again, we'll continue. The idea here was to put this mine into production, make it cash flow, take some of the cash flow, and finish developing the rest of the property without diluting shareholders to do so. So that was the idea here. But again, it's very prospective, and that's one of the reasons we like this, is it has a lot of opportunity for growth, not only from a mine life, but from a production perspective as well. Finally, our last project is the Mont Sorcier project in Quebec. One thing that we like about this project is it's blessed with infrastructure. Typically, when you bring in an iron ore mine, some of the ones coming online in Australia, they're hundreds of miles from the coast. There's nothing there, so they have to build rail lines to the coast. They have to build port facilities, and so where we're blessed here is that this used to be a very robust logging area. And so there's a CN line, which is the National Rail Company, that runs from the town of Chibougamau right to the port of Saguenay, which is 370 kilometers. That rail is only at 30% capacity, so we can access that. Also, the port of Saguenay, the government just spent about $500 million upgrading this port. It's a deep water port, so we already are working with them and have secured our spot there to be able to ship our product and load it on boats at Saguenay. So from an infrastructure perspective, we're going to be saving billions that we don't have to spend building infrastructure. The only thing we have to spend is we need to do a 25-kilometer spur from the mine to the railhead. That's it. From an infrastructure perspective, it's excellent where we're located. The other thing is Quebec has a lot of very large dams, and they produce low-cost hydro, which we're going to have access to as well. And so we're very excited about this. As I mentioned, we're doing a feasibility study on the project right now, which will come out in the first quarter of 26. We had previously completed a PEA on the project, and that was done at 65% iron ore concentrate. We've now upgraded to 67% iron ore concentrate. The other thing I like to point out is that the silica and aluminum, which are considered the nasties, it's below 2.5%, which is one of the lowest in the areas. Most of the other mines here in Canada see silica and aluminum 4% or higher. So very attractive product that we have. This project would cash flow 350 million, 235 million free cash flow for 21 years, and that was at 65%. So we've now concentrated to a 67%, so that would be even higher. The other thing I like to point out is we're looking at about a 5 million ton in the PEA, 5 million tons of annual production. Total cash cost would have been $26 a ton, $28 all-in sustaining cost. The rail to transport it to the port was another 18, and then the ocean freight to China was 20. However, this product is very much in demand here in North America, as well as in Europe and the Middle East. So we imagine that this cost will be a lot lower than this. And so we'll probably be looking at a CFR total instead of 66 of something more around $45 a ton. And so the cost to build this project was about $500,000. We know that is going to go up with inflation a bit. However, because we've increased from 65 to 67%, the increased NSR per ton will offset some of those increased CapEx costs that we're seeing. So again, It had a 1.6 NPV, 43% IRR, and a payback of less than 2 years. And so with this project, it's down the road a bit. We're completing our feasibility study in the first quarter. You would do environmental in Q3 26. Your financing would be done by 28, and then you would start construction in 2028. Now, just to be fair, a lot of people ask, what is an iron ore company, or why is this project in your portfolio? And so what we're doing right now is we're looking at all sources. So we are going to complete the bankable feasibility study, which will help to lock in the economics on the project. At that point, we're going to do a review of the project and decide, do we build it ourselves? Do we joint venture it? Do we sell it? What are the options available to us? Because you can definitely say there's a lot of upside to the cash flow. So to maybe even keep a part of it become a minority partner and let a steel mill or somebody who wants to build it be the majority partner. There's multiple options. So I can't tell you what is going to happen with this, but I can tell you once the feasibility study is done, they're going to take a step back and review all the options and decide what is the best path going forward.
Mike, just one quick correction. When you're talking about capital cost, you said 500,000. It's obviously 500,000,000.
500 million, sorry,
Yep.
yes.
Yeah, no problem. And you kind of answered this question. With the higher capital costs at Mont Sorcier, would you have to take on a JV or would you sell it after the bankable feasibility study? I mean, you did say it gives you, the bankable feasibility study gives you optionality. But, in kind of in your mind, do you see the company taking on a JV partner, or is this something that maybe you want to divest and just move on from?
So I don't, in my mind, I think we could, like, again, it would be certainly nice to take advantage of some of this, pretty much annuity cash flow for 21 years. And there is expansion potential on this property. Again, the resource is only is only considering a third of the resource for the life of mine. So there's significant upside to this. This could be a much longer mine life. It could throw off a significant amounts of cash for a long period of time. And so, to give it up completely, I don't think we if you look at what you would get for this with an NPV, it's a fraction of what you would get from cash flow over a longer period of time. So could we build this? What would it cost us? Again, similar to the project in Portugal, we've already talked to the UKEF Expert Credit Agency, who's willing to backstop the project financing requirements. And in Canada, it would be TD Bank that's going to be doing the lending. So that would be 70% of the capital cost. An offtake would probably take you another agreement with someone would probably bring you another 15 to 20%. And the remainder would have to be equity, which at that point, if you consider this, you have the mine in Argentina producing significant cash flow. You'll have the mine come online for a couple of years in Portugal. So the company would have cash. So again, they could essentially bring this to production without any dilution to the shareholders. But, do we bring in a venture or do we sell it? I can't say. The board is going to decide that, and they're going to review all the options. So if I say anything, it's just my guess. Like I would say potentially a joint venture, but again, that's my best guess. The board is going to review this once the feasibility study is done.
Yep. I know it's a hard question to answer, but
Yeah.
thank you for giving us your best shot with what you could say. Yep.
Yeah. So again, the only thing I like to point out on this chart is from a resource and grade perspective, this is the best mine out there, short of Black Iron has the Shimanivsky project, which is 68% concentrate instead of 67. However, this is located in the Donbass region of the Ukraine, so this isn't going to be built anytime soon. So we're one of the best projects out there. And again, very large mine life. We have over 1 billion tons of resources on this. And again, that's only on about a third of the deposit. So there's still a lot of opportunity to see this become a much longer mine life, or they could ramp up production to say, from 5 to 10 and see the cash flow even stronger. So there's multiple opportunities in place to see this be a much bigger mine. So just going a bit of a recap here. We're well funded to delivery. We have 14.5 million in the bank right now. We're seeing free cash flow of 25 million, which is more realistically like 50 million coming from Argentina based at the current gold prices. We still have another 15 million coming in asset sale and option agreements. So the balance sheet is in a very healthy place. As I mentioned, we're working with UK. So some people don't understand this. When we had these projects, you used to have banks like SocGen, Deutsche Bank, the bigger banks would lend against mining projects, and they've kind of stepped back from that model now. And so, who has stepped in is the UK Export Credit Agency, the US Capital Agency. So, when we had these projects ready to go, we shopped it out to UK, Canada, US, Norway, Germany. There was a large group that we put the project out to. We got responses back from almost all of them. The UK was the most aggressive in their proposal. They're willing to give 100% guarantee on the project risk, the financing risk. They backstop everything, provide the covering the pre-capital, working pre-capital, the pre-construction interest, everything. So essentially, there's no risk for Santander or TD to come in and lend against this project. To do that, what they ask is that you spend 40% of your capex on UK goods, services, consulting, engineers, whatever the case may be. Our engineers said we could go up as high as 60. So it's easy to meet our target. We also had to meet the Ecuadorian principles, provide a social and environmental impact study. So we've been able to cover all of these. So what that allows, as I said, TD Santander can come in and lend pretty much at a sovereign debt rate. So you could see a 5% or 6% interest rate over a 10 to 12 year period. So very friendly debt financing on this. And additionally, what they allow is if we brought in a stream from Sprott, they allow that to add to the 30% equity portion that has to be paid. So 70% would be the non-recourse project financing, 30% would be equity. And so with that, they allow you to include a stream. If you do an offtake agreement, that counts there. So again, the equity component could easily be covered by the company without any further dilution to the shareholders. And then just to show you who has done this before, the team has been together for about 25 years. They started with the Desert Sun Mining, which had the Jacobina project in Brazil. They brought that for about $2 million. They took it out of care and maintenance. They ramped up through drilling and expanded the resource on the mine life on the project. They ramped up production at the project and turned around, sold it in 2006, 4 years later, for almost $600 million to Yamana. So a very positive return for shareholders. They then went on and took Largo, which was the highest grade vanadium project in the world still to this day. They took that from cow pasture. So they did the technical studies, they did the drilling on it, they constructed it, brought it into production, ramped up production. And when Mark left, it had gone from probably a 20 million market cap up to a market cap of about 2.5 billion when he left. He then spent about a year or two at Sierra Metals. They had some issues. They had a low mine life. They were having some safety issues, some mud rushes. He cleaned that up. He ramped up production. He ramped up the exploration program, significantly improved the resource there, and saw the price go from about 80 cents up to about 350 in the time that he was there. So again, a good turnaround for shareholders. And so Mark likes to have a strong team, not only in the corporate office, but also at the mines. So the teams at the mines can advance and do a lot of the work. It doesn't drain a lot of the time of the corporate team here, and they're able to expand and grow the projects with minimal oversight. So very strong team, not only in the office here, but at each of the mines. Looking at our capital structure, share price is $1.27 Canadian as of September 29th. And we have an outstanding share count of 134 million, which is fairly low for a company of this size. 143 million fully diluted, market capitalization of 170 million Canadian, and the cash position of 14.5 million, with another 15 million due to come in just from project sales, not to mention cash flow. We do have some research coverage that's running at about $1.60, $1.70 on the project. I think as we deliver key milestones, including the feasibility studies, the exploration reports, and continue to move the project forward, we should see these target prices increase significantly. Heiko is very conservative on his estimates, and he wants to see a few milestones hit before he ups his target price. In terms of ownership, management and the board have about 11%. We also used to be much higher than that. We used to have a board member that had about 6%. He has not sold his shares. He's still friendly to the company, but he retired, so we can't include his share count in the management board anymore. But those shares are still held in friendly hands. We have the EMF fund, which is about 1%. We have a handful of other institutions that have about almost 1%, so that it represents about another 5% of the company. But we still have a significant free float at about 83%. We have seen or recently found out we have a Nordic fund that bought about 6%, so that actually needs to be out of it. It's a little bit lower than, so the free float would be more like about 77%. So just to cap it up, we're a steady state gold producer, producing about 55,000 ounces to 60,000 ounces over the next few years. Obviously, with the exploration we're doing there, we should be able to see that production ramp up, as well as expand the mine lives at the property in Argentina. In terms of what we do with that cash flow, we have a mine in Argentina that we're building, or sorry, in Portugal that we're building. That'll bring on not only some extra precious metals, but also some critical minerals, and that will come online starting in 28. But we'll continue to advance that project with feasibility studies and financing and other information coming forward. And then longer term, we have the Mont Sorcier project, which we've talked about in detail. Whether that's us that builds that or whether that gets sold will be determined. But again, it still offers a lot of long-term value for the company, no matter what way we go with that. And so company's well funded. As I mentioned, we have a significant cash balance as well as other cash coming in through cash flow and additional asset sales. So we're fully funded to be able to bring these projects to fruition without seeing a lot of dilution to shareholders. And given the short time frame of 5 years, there could be significant valuation improvements to shareholders without diluting them. So I'm going to wrap it up there, and I'll put it back to you, Anthony, to see if there's any questions.
Yeah, there are a bunch of questions in queue already. If you have a question, please type it in the Q&A or chat box. We'll make sure it gets answered. You just kind of mentioned, the time frame here. One of the questions that came in is, what is the long-term vision for the company over the next 5 years? And you showed it on a slide earlier. But this is a company that could be, you said the cash flow could be somewhere in the $500 million range, correct?
Correct. And yeah, and then so that's the time frame for the existing assets. I don't, from an M&A perspective, we continue to look at opportunities. We have strong teams in Canada and Brazil, in Argentina and the Americas, as well as in Europe and Portugal. So we're continuing to look, probably not so much on the critical minerals side, probably more on the precious metals side. But we're continuing to look at other opportunities that may be out there. So we have a strong 5-year program with existing assets, but there may be more to come. I can't say too much about M&A until it happens, but if it does happen, I think it would be more of a precious metal component addition.
Yeah, which is one of the questions about opportunities for acquisitions. And so you are actively, you're always looking, so that could also add to the 5-year plan as well. Has management and board considered an uplisting, maybe NYSE American?
Yeah, so there's a couple of rules around that right now. We are looking at that, and we believe that the time may not be right just yet, but we are looking at potentially by the end of sometime in 26, because we do have to hit a price target. Otherwise we're going to have to do a rollback. But we only have 130,000 shares out there, or 130 million shares. So if we roll it back too much, we're afraid it'll hurt the liquidity. So we're trying to work on the share price. But if we can get that share price up, I think that's something that you could see by the end of 26, that we would have an uplisting to the NYSE American or NASDAQ.
Yeah, definitely wouldn't make sense to roll back the shares with so few outstanding. Do you think the upcoming midterm elections in Argentina could negatively impact the progress they've made in monetary policy?
Nope. I think they know what's happening. They know where their bread and butter is coming from. They know that the mining is one of their key industries, and they know that if they bring back currency controls or other negative policies, it's not going to help them. It's only going to cause mining companies to stop investing in company, and so, or in country. And so we've seen the currency controls removed. Anything we produce in 2025, we don't have to return that capital to Argentina. It can come right to the head office here. And so we're very excited about that. We know that even with the visit Malay had in the U.S., they're looking at they're going to be getting potentially some capital there as well. But also, you've seen some significant investment announcements, including McEwen and a few others. There's probably about 6 billion of investments to be made in country in terms of expansion, and they know that if they go back to negative policy, those foreign investments are not going to happen. And so they want the royalties or the taxes on the projects and to help their economy to grow. So I don't think we're going to see a return anytime soon to the negative policies.
Great, thank you for that. What is the process for being able to use or build an on-site lab from a financial and regulatory standpoint?
So there's basically ISO standards that have to be met. So in terms of the processes, the type of equipment, um, that has to be all it has to all be audited from an ISO group and certified. And so the cost, like that part of the cost, is not so hard. We have pretty much all the equipment we need already. It's more of a knowing that they're following the steps in the process. So the cost would not be significant. If I had to guess, it's going to be less than $500,000 to do that. In probably, then that's like a thumbs up number. It's probably even lower than that. So that part of it is not expensive at all to certify your lab. And in time frame, in terms of a timeline, that could probably happen in 3 to 4 months.
And how much time does that save you in terms of assays and publishing that kind of?
Significant. So when the lab is back up, sometimes we're waiting for two. Sometimes we've even seen results take 3 months to come back. If we have the labs in house, we could have results within a week.
Wow, that's fantastic. So a lot of questions about Q4. So do you feel the higher grade in Q4 will have a material impact on earnings?
Yes.
Okay, and then how much lower do you think you can get the all-in costs down?
Yeah, so we're
Q4.
we're guiding 15 to 1700, I think, in Q4. With
Wow,
if in Q4 we can get that cost down closer to the 1500 level.
great. Can you discuss how much added cost the new drill rigs will cost and that wasn't previously budgeted? And do you have the funds or will you have to take on debt or do an equity raise?
No, we're not. We have the funds. We're not purchased like so the drill we have on site now is ours. We own that one. The RC one is a purchase as well. So that was made. That was I think a couple $100,000 for that drill. The other ones are going to be contracted to drill. So I don't believe we're going to own those. So that'll be at a cost like a rental cost per month. And so I think the way that works is in terms of drilling, by having an internal drill, our cost per meter is probably about 100, like all in. That's like the cost to drill, assay, everything is probably about $150 a meter. With the rental, that would probably be about 200. So it'll be a little bit higher in cost in the sense that there's a rental included per meter for that. But given the ability to ramp up the production and the mine life, we believe that's a worthwhile expenditure.
Great.
I'm not sure if I hit all the answers on that one. If
You,
there's
you
anything
did.
else.
Yep, absolutely. Any royalties on any of the projects?
Yes. So well, there's not a royalty. There's a stream on the project in Argentina. So Sprott Streaming gave us $25 million for that. We had to deliver 6.5% of production up to 29,500 ounces to them. Once that's delivered, that drops down to 2.5% of the production. And we have the ability also to reduce payments to 1.25% of the production by with a payment of $2.5 million.
Okay, great. A couple more questions and we'll wrap up. Any debt? If so, what is the cost of debt and when will it be paid off?
So the debt is coming down. So when we brought in when we brought on sorry, my mind's not working. Um, the project in Argentina, Ascendant Resources. Sorry, my mind blanked out. When we brought on Ascendant Resources, our debt level came back up to 51 million. We're going to have that paid down to about 31 million by the end of the year. However, some of that is not debt that will go away. For example, we have a $25 million position on a project in in Portugal, which is going to turn into a stream. So that debt will never be paid. It just sits there as a debt line. However, once we go into production in Portugal, then that will become a stream, and then it'll be paid off through the stream. So that's not debt that we can actually repay. For all intents and purposes, payable debt by the end of the year should be down to less than 10 million. Hello?
Sorry, Mike, I had it. I
Oh,
had it.
okay.
Why do you think there's a disconnect between the value of the company and the stock price? Maybe Q4 might be the best opportunity for a re-rating.
Yes. Two things. One is the low mine life in Argentina. So we've got about a 2-year mine life there. Investors typically like to see 10 plus years. Our neighbors have about 6-year mine lives in Argentina. So with the drilling program that we're doing, I think that's going to be a huge addition. I think the stock reacted positively to the news today of ramping up the program, because with a higher mine life, there's a certainty that you're going to be in production for a longer period. And so the shorter mine life does impact us. However, we are addressing that with the exploration program. And so and we're having some good success. So I think by the end of the year, you'll have a good indication of what the potential increase could be. The 43-101 would be done next year, which would lock in from a technical perspective and an economic perspective what the mine life would be. But they'd be able to put out a drilling report by the end of the year that's going to show you what the potential is before we put out the actual technical report. So that's going to be a big one. The second one is, I think people want to see us get our permits and want to see us advance in Portugal. Again, with the updated feasibility study, with the environmental permit, those are some key milestones, which I think will have some people that have been sitting on the sideline be willing to come in and invest. So other than that, you know what? I think, we had about a year ago that we had sold that project in Brazil. Some people didn't like that. Most of those shareholders have gotten out of the stock now. So I don't think, other than de-risking, which is coming through these milestones, is what's holding us back. And I think by the end of the year, we could see a lot of those milestones out there, which should help to de-risk the company and the stock so that we could see growth.
Yeah, absolutely. Well, thanks, Mike. I want to thank Mike McAllister for coming on and getting everybody up to speed on Cerrado Gold. Definitely the right time to be looking at the company. Positive outlook for precious metals, the progress being made at all the properties. We think that there's a very bright outlook for this company. And so we're really, really excited to watch them. The stock has done really well this year, and we can believe that it will continue to do well. Mike, before I wrap it up, any parting words for our guests?
Again, thanks for taking the time to listen today. I always appreciate your time. And I definitely ask you to keep an eye on it. Keep an eye on the news flow. I think by the end of the year, you're going to see significant announcements that will help to further de-risk the project. And even, again, within a short time frame of 5 years, you have the potential to see cash flow on this company go from 50 million up to almost 500 million. So and for a mining company in a 5-year time frame, that's unheard of. So it's there's definitely opportunity here. So I strongly encourage you to keep an eye on the stock and keep an eye on the news.